I lost $13,000 and I didn't even notice it happening. No bad investment, no scam, no crypto crash, no single moment where I could point at the screen and say, that's where it went. It just quietly disappeared over 3 years while my savings account balance stayed exactly the same. The number on my phone never moved, but what that number could actually buy shrank every single year. And the day I finally did the math, sitting at my kitchen table at midnight with a calculator and a coffee that had gone cold, I felt genuinely sick. Not panicked, not angry, just sick, because the money wasn't stolen from me. I handed it over voluntarily by doing the one thing I was absolutely convinced was the responsible choice. I did nothing. My name is David, and today I'm going to tell you exactly how I lost $13,000 without spending a single dollar, why it took me 3 years to figure out what was happening, and precisely what I did the week I finally woke up. Because if you have money sitting in a savings account right now, and you haven't made a move yet, the same thing is happening to you right now, today, while you're watching this video. And the worst part is it feels completely fine while it's happening. Here's the setup. I was 29. I'd spent 4 years being genuinely disciplined with money, packed lunches, no vacations I couldn't afford, said no to things constantly. And eventually I crossed $50,000 saved and felt this enormous rush of pride that lasted maybe 6 seconds before being replaced by a completely different feeling: overwhelm. Because suddenly, I had enough money that getting it wrong felt catastrophic. Index funds, Roth, IRA, 401k, real estate, bonds, high-yield savings. Everyone had an opinion. Every article contradicted the last one. And the fear of making the wrong call felt worse, much worse than making no call at all. So I made no call. I told myself I'd figure it out next weekend. That next weekend became next month. Next month became next year. And my $50,000 sat in a Chase savings account, earning 0.01% annually, while I read articles about investing without actually investing anything. Here's the math I eventually did at that kitchen table. U.S. inflation over the last decade has averaged around 3% per year. My savings account was paying 0.01%. The gap between those two numbers is not a rounding error. It's 2.99% of my money evaporating every single year in the form of purchasing power I would never get back. On $50,000, that's roughly $1,500 gone annually. Silently, without a single notification on my phone. After 3 years of doing nothing, my account still said $50,000. But it could only buy what $45,500 would have bought the day I started. I didn't blow the money. I didn't make a bad bet. I was just cautious. And that caution cost me $4,500 in 3 years. Extrapolate that to 10 years and the number is $13,000. That's the invisible price tag of inaction. And invisible price tags are always the most expensive kind. The thing that made it so insidious was that doing nothing felt like discipline. It felt like I was protecting something important. Every time I almost pulled the trigger on something, I'd find a reason to wait. The market seemed high. There was uncertainty in the economy. I hadn't done enough research yet. I wanted to understand it fully before committing. These all sounded like responsible thoughts, and every single one of them was costing me money every single day. There's a concept in behavioral finance called loss aversion. The psychologist Daniel Kahneman, who won a Nobel Prize for this work, found that the pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. When you're sitting on $50,000, the thought of losing $10,000 doesn't feel like losing 20% of your savings. It feels like losing 40% of your sense of security. Your brain isn't broken when it reacts that way. It's just running ancient software designed to protect you from predators, not optimize a brokerage account. The problem is that in personal finance, that ancient software will quietly bankrupt you while making you feel responsible the entire time. I was running that software for 3 years, and the bill was $13,000. The week I finally did something about it. I didn't suddenly become brave, or knowledgeable, or certain. I just got tired of knowing the math and ignoring it, so I sat down, found a simple framework, and executed it. No advisor, no complex strategy, no predictions about the market, just a clear order of operations that I wish someone had handed me the day I crossed $50,000. Here's exactly what I did. The first thing I did was move my emergency fund to a high-yield savings account. This sounds so simple that most people skip over it. Don't. I had about $15,000 set aside as my emergency buffer, 3 to 4 months of living expenses. That money was sitting in a Chase savings account, earning 0.01% annually, $1.50 per year, for $15,000. Meanwhile, as of early 2026, the best high-yield savings accounts are paying between 4 and 4.21% APY, federally insured. Just as safe as Chase. Openable online in about 10 minutes. I opened one in 11 minutes, transferred the $15,000, and in the first year that single decision earned me $615 in completely passive, completely risk-free interest. The same $15,000 in my old account would have earned $1.50. That gap, $613.50 in year one alone, is the cost of not knowing this existed. A Santander survey found that 69% of Americans still keep their savings in low-yield accounts. Not because high-yield accounts are complicated or risky, just because nobody told them to switch. I'm telling you now, do it this week. It takes 11 minutes and it's the easiest money you will ever make. The second thing I did was fix my 401k contributions to capture every dollar of my employer match. This is the part that genuinely made me want to go back in time and shake myself. My employer offered a 100% match on the first 4% of my salary, which means for every dollar I contributed up to that threshold, my employer put in another dollar. A 100% instant return before my money had done a single thing in any market. And for 2 years at that job, I had been contributing 2%, leaving the other 2% of free money sitting unclaimed on the table every single pay period because I hadn't properly read the enrollment documents. A Vanguard study found that some employees leave up to $5,000 per year in matching contributions uncaptured. $5,000 a year, compounding at 7% for 30 years, is over $500,000 gone because paperwork felt like a lot on a Tuesday. When I finally fixed my contribution rate, it took me about 8 minutes. 8 minutes to claim money that was already earmarked for me. If you haven't checked your 401k match situation recently, stop this video right now. Go check it and come back. I mean that. This is the only guaranteed double-digit return available to a regular person, and it requires nothing but one HR form. The third thing I looked at was my debt situation, because where you go next depends entirely on what you're carrying. If you have credit card debt at 20, 21, 22% APR, and the national average right now is above 21%, paying that off is a better investment than anything the market offers consistently. The S&P 500 has returned around 10% annually over the long run. Paying off a 22% credit card is a guaranteed, risk-free 22% return. No investment on earth offers you a guaranteed 22%. Not index funds, not real estate, not anything. Kill the high-interest debt first. The math is unambiguous. For student loans, the calculus is more nuanced. Under 5% interest, prioritize investing. Above 7%, prioritize payoff. Between 5 and 7%, choose whichever path you can genuinely sustain for years, because the best financial plan is the one you don't abandon 8 months in when motivation fades. I had no credit card debt, and my student loan was at 4.3%, so I moved straight to investing. If you're in a similar position, so do you. The fourth thing I did was open a Roth IRA and max it. In 2026, the contribution limit is $7,500 if you're under 50, You contribute after-tax dollars. Everything grows completely tax-free. And when you withdraw in retirement, you owe the government nothing. 0 on potentially hundreds of thousands of dollars in gains. The IRS just lets you keep it. Here's why this timing matters specifically for most people watching this. If you're in the 12 or 22% federal tax bracket right now, you're paying tax at a relatively low rate today. Your money then grows for 3 or 4 decades, and you never pay taxes on any of that growth. Not a cent. The Roth IRA is paying a small tax bill at today's lower rate to avoid a much larger tax bill later when, if this plan works, you'll be in a higher bracket. I put $7,500 into a Roth IRA invested in a simple S&P 500 index fund. At the market's historical average return of 10% nominal, that's $7,500 left untouched until I'm 60, becomes approximately $130,000 to $30,000. Tax-free. The government gets nothing. I keep everything. That single contribution, made in an afternoon, will do more financial work than most of my paychecks combined. And all I had to do was open an account, transfer money, and buy one fund. The fifth thing I did was increase my 401k contributions beyond the employer match. In 2026, you can contribute up to $24,500 annually. Every dollar comes out pre-tax, which means it reduces your taxable income today. If you earn $80,000 and contribute $15,000 to your 401k, you only pay income tax on $65,000 that year. Depending on your state, that saves you somewhere between $2,000 and $3,500 that would otherwise have gone directly to the government. Instead, it goes directly into your retirement account and starts compounding. The government is subsidizing your wealth building. It's in the tax code, it's legal, and most people dramatically underuse it. The sixth thing I did was change how I was using my health savings account, and this one genuinely changed how I think about money. If you're enrolled in a high-deductible health plan, the HSEO is arguably the most powerful account in the entire U.S. tax code, and almost nobody knows how to use it correctly. The triple tax advantage it offers exists nowhere else in American personal finance. Contributions are tax-deductible, so you reduce your taxable income going in. Growth inside the account is completely tax-free, and withdrawals for qualified medical expenses are also tax-free. Tax break going in, tax-free growth, tax-free coming out. All three, simultaneously. Before I understood this, I was using my HSA, like a debit card for copays. The money went in and came right back out within weeks. That's not wrong exactly. But it's like using a Ferrari to pick up groceries. It works, but you're completely missing what the thing is actually capable of. The correct move, the one I now use, is to pay current medical expenses out of pocket when possible. Invest the HSA money in index funds inside the account. Save every receipt and reimburse yourself years later from an account that's been compounding the whole time. There's no time limit on reimbursement. A receipt from 8 years ago is valid today. I now treat my HSA like a stealth Roth IRA with a bonus tax deduction on the front end. And the shift in how I think about that account took about 20 minutes to understand and has changed the long-term math meaningfully. The seventh thing I did was invest the remaining capital from my $50,000 in the simplest possible way. And this is where I need to be very direct with you, because the financial industry has spent enormous resources convincing you that this part is complicated. It is not complicated. After the emergency fund, the 401k match, the Roth IRA, and the HSA contributions, I had money left over that went into a taxable brokerage account, and I invested it in 3 funds. VTI, a total U.S. stock market index fund with an expense ratio of 0.03%. VXUS international stocks at 0.07%. BND U.S. bonds at 0.03%. That's it. 70% U.S. stocks, 20% international, 10% bonds. I set it up in one afternoon. I have not meaningfully changed it since. The SPIVA scorecard, which tracks how professional fund managers perform against their benchmark index, shows that over 15 years, more than 90% of actively managed funds underperform the index they're trying to beat. Over 20 years, it's closer to 95%. These are people with Ivy League MBAs, Bloomberg terminals, teams of analysts, and proprietary research. 95% of them lose to a fund that just owns everything and charges you almost nothing to do it. Warren Buffett made $1 million public bet on this in 2007 against a professional hedge fund manager. The index fund returned 125.8% over 10 years. The hedge funds averaged 22%. Buffett won by a landslide and has since said he wants 90% of his wife's inheritance in a low-cost S&P 500 index fund. The greatest investor alive, pointing at the boring option for his own family, is about as clear a signal as you're going to get. The expense ratio difference alone between an active fund at 0.60% and an index fund at 0.03% on $50,000 over 30 years costs you roughly $100,000 to $34,000 in fees, not in worse performance, just in fees. Keep it simple, keep it boring, and then do the last and most important step. Automate everything and stop looking at it. This is the step I almost skipped because it sounded too passive. It's not passive. It's the most sophisticated financial decision you can make. Here's why. Dalbar's annual investor behavior report found that in 2024, the S&P 500 returned 25%. The average equity investor returned 16.5%. That 8.5 percentage point gap didn't disappear into bad fund selection. It disappeared into emotional decisions. Buying high after watching the market run up for months. Selling low after a correction that felt like a collapse. Sitting in cash waiting for a better entry point while the market quietly recovered without them. JP Morgan calculated that missing just the 10 best trading days over a 20-year investment period cuts your portfolio value by more than half. And 7 of those 10 best days historically happen within 2 weeks of the 10 worst days. The people who sell during a panic sell right before the recovery every single time. They experience all of the fear and none of the reward. They didn't lose money to the market. They lost money to themselves. I know this version of myself. I've met him during corrections. He is catastrophizing. He is certain this time is different, and he absolutely cannot be trusted with financial decisions. The solution is to remove him from the equation entirely. Set up automatic contributions to every account. Pick your allocation once. Then stop giving yourself the opportunity to intervene. Morningstar found that investors in target date funds, the most boring hands-off option available, lost only 0.4 percentage points annually to bad timing decisions, versus 1.2 points for investors in more complex funds with more decisions to make. The more opportunities you give yourself to react emotionally, the worse your returns get. Automation doesn't just save you time. It saves you from the version of yourself that exists at 2 a.m., when the market is down 18%, and every headline is screaming that this is the end. That version of you will cost you 6 figures over a lifetime if you give him the chance. So here's where I am now, a few years after that midnight calculation at the kitchen table. The emergency fund sits in a high-yield savings account and has generated thousands in passive interest without a single additional decision. The Roth IRA has been compounding in a simple index fund and is meaningfully larger than what I put in. The 401k, with employer matching and increased contributions, has grown faster than I initially projected. The taxable brokerage account is doing exactly what boring index funds do over time, which is grow steadily and unremarkably in a way that adds up to something significant when you stop checking it constantly. I did not double my money on a single stock. I did not time the market. I did not have any special knowledge or insider access or financial background. I just followed a clear sequence at a moment when every instinct I had said to wait a little longer. And then I automated it and got out of my own way. Charlie Munger said it plainly. The first $100,000 is a beast, but you have to do it. Once you get there, the math starts working for you in a way that changes everything that comes after. At 7% annual returns, $100,000 generates $7,000 per year in passive growth without you lifting a finger. The second $100,000 arrives faster than the first. The third, faster than the second. Not because you got smarter or luckier. Because compound interest, once it has enough mass to work with, accelerates. And the people who interrupt it constantly through emotional decisions or paralysis or waiting for the perfect moment never get to feel what that acceleration actually does. I spent 3 years interrupting it. I know exactly what that costs. I can tell you the number. It's $13,000, and it represents 3 years of feeling responsible while actually bleeding purchasing power every single month. You have the same choice I had at that kitchen table. You can close this video, tell yourself you'll figure it out this weekend, and let the invisible price tag keep running. Or you can open your banking app tonight, find a high-yield savings account, transfer your emergency fund, fix your 401k contribution rate, open a Roth IRA, and start the sequence. The emergency fund transfer takes 11 minutes. The 401k fix takes 8. The Roth IRA setup takes 1 afternoon. Everything else flows from there. You've already done the hardest part. Most people never save $50,000 in the first place. The discipline you needed to get here was genuinely difficult, and you've already demonstrated you have it. What comes next is not hard. It's not complicated. It doesn't require expertise or perfect timing or certainty about the future. It just requires a decision made today instead of next weekend. My name is David. I lost $13,000 learning this the slow way. You don't have to. Now I want to hear from you. Drop a comment below and tell me honestly, where is your money sitting right now? High-yield savings, invested, or still in a checking account that you've been meaning to deal with for a while? No judgment. I was in that last category for 3 years. Just be honest, because sometimes saying it out loud is the first step to actually doing something about it.